Okay. Thank you. Good afternoon, everyone. Still room in the front row for those who are arriving. So good afternoon, everyone. And to those of you who are joining us online, this session is going to be live streamed. We have all witnessed how low gilt yields have fallen over the past few years, and even more so recently. And whilst they've rebounded a little bit over the past few weeks, they are still at extremely low levels. The implications of low yields are very diverse, and clearly 35 minutes, which we have today, do not give us enough time to properly cover those implications. However, I hope that we'll be able to address a few. To do that, I'm very fortunate to be joined by two distinguished speakers. So first, Sorca, who heads up the Pensions Advisory and Solutions team at JP Morgan Asset Management for the EMEA region. And Sorca will give us a broad perspective of how this affects pension schemes in the UK and perhaps in the Q&A elsewhere. And James is the Director of Pensions Investment at the BBC Pension Trust and will be able to talk or give a direct perspective of an asset owner. The way we're going to run the session will be to start with Sorca. He's going to give us a short presentation, and that will be followed by James and some comments, and then we'll go through a Q&A. People in the room and people online, you can all submit your questions through the app. I should be able to see it, so it works, and I will pass it on to the speakers. Let us start. Sorca, please.
Thank you, Thomas, and good afternoon, everybody. So from Nero to zero, are we fiddling while gilts burn? Well, my 9-year-old daughter is very much into horrible histories at the moment. It's kind of a sketch show, tongue-in-cheek sketch show for kids, which brings to life particularly gruesome or brutal episodes of history. And I was caught by an episode she was watching recently because it was about Nero and his habit of getting subjects that displeased him, crucifying them, pouring a flammable substance over them, and setting them alight. Very pleasant stuff. And they were Roman candles, so-called Roman candles that he used to decorate his garden parties. I can't imagine that those parties were very much fun. But with that insight into the quality of my historical sources, let me venture an analogy. So are we sort of crucifying pension funds with regulation and then setting them alight with these low gilt yields? And I think where I come out is that we did tie them to the stake quite some time ago, actually, when we bound them to promises that we didn't fund and collateralize at the time of making them. And that's particularly around inflation protection that we applied over the course of the 1990s, principally. But it's not gilt yields that have set them alight. It's the fact that we're facing low productivity, low growth, and therefore lower returns from assets. And it's that low growth which has, if you like, set them alight and made it more difficult to fund pensions. So low yields are not the cause of that, they're the response to it. And in the same way, they're not the cause of the problems we have with pension funding. But if they are alight, the last thing we want to do is fan the flames. And I think some of our frameworks and ways of approaching the funding challenge do risk doing exactly that, because they're so very anchored on gilts. We frame the whole funding challenge around gilts, and we invest against that framework as well and correspondingly anchor on gilts. And that means that any stress and volatility in the gilt market gets immediately transmitted and amplified into the pension fund market. And I think that we all stand enthralled to these headlines about how pension deficits are moving around and gyrating from day to day. I don't believe that's always helpful. I think it can be, at best, distracting, and at worst, can drive us to make poor investment decisions. So we think there's a better way to sort of more broadly base your valuation framework and invest accordingly that can better stabilize your balance sheet. You can better risk even if you can't de-risk. So that introduction, there are three things I want to talk about today. The first is from Nero to zero, how we got to where we are today and why that makes pension funding harder. but that de-risking and the stall in de-risking that we're seeing is not fiddling while Rome is burning. It's a necessary response to that low growth environment. And then thirdly, given that it's difficult to de-risk from here, how can we better risk? And in particular, how can we broaden the definition of what can collateralize our liabilities and stabilize our balance sheet accordingly? So let me start out with the longest history of UK interest rates that I could find. This is from a rather better historical source. It's from the Bank of England. Those history buffs among you might notice that it actually goes back to before the creation of the UK, which was founded in 1707, although I couldn't quite get all the way back to Nero. And as you can see, we had sort of a century and a half of very, very stable interest rates, about 4 to 5%. And then they kind of began to move around more substantially with the Industrial Revolution, when the need for capital with that economic expansion led to the more familiar practice of monthly resetting of interest rates. We had a bit of a pause during the Second World War, and then the enormous expansion post the Second World War. So we're seeing interest rates rising there because what came with that expansion and growth was inflation, and interest rates were the primary mechanism to fight that. That was largely from the 1970s onwards. The battle was against deflation, and we went from reactive interest rate setting policy to much more proactive interest rate policy in order to combat inflation. And we've largely managed to beat inflation. Now that battle is won, the problem we have is waking it back up again. The inflation beast is very much asleep. And the slump that we experienced after the financial crisis has largely been averted from turning into a Great Depression by the action of central banks and extraordinary monetary policy. I think the belief is that they were successful in that regard, but where they have not been successful is in generating inflation or growth anywhere in the developed world. And despite sort of persistently low interest rates to try and stimulate this growth, the trend keeps going against us. The demographics of that are well understood. We have a maturing workforce, but the lack of productivity growth and the lack of animal spirits remains something of a mystery. And this persistently low interest rate is a response to that, and it does mean we face low returns from bond assets. And of course, that low productivity and growth is a serious headwind to the returns from equities and other sort of financial assets. And that is what's making pension funding so very difficult. And we're so used to the shorthand that yields go down, liabilities go up, that I think sometimes we lose a little bit of sight of what's actually behind that. And what it is that when yields are going down, it's an indicator that we're expecting low returns in the future. And we are relying on investment returns to at least partially pay for the benefit promises that we have made. We're trying to make this equation balanced. You've got two ways to pay for the pension promise, the cash contributions, and the investment returns that you earn on those contributions. And when the investment returns that you expect to earn come down, it reveals a shortfall relative to how you expected to pay for those benefits. And that's what's behind our shorthand of yields go down, liabilities go up. It's that the left-hand side of this equation isn't big enough anymore to meet the right-hand side. So our expectations have been falling quite consistently. And at JP Morgan, we do an annual exercise which is looking very broadly across the world at demographic trends, trends in productivity, what that means for growth, what it means for inflation, how that might be expressed in interest rate markets and in equity and other financial asset returns. And on this chart, is it a greeny blue on the right-hand side of each group of three? I've shown what those assumptions would have assumed for a typical UK pension scheme allocation, the returns that we would have expected from that over the last few years. And you can see it's been coming down steadily. And I'm showing against it how yields have come down. Gilt yields are nominal, 20-year gilt yields are the red bars, and index-linked real yields are the ones that are going negative. And you see they've been coming down steadily, and our return expectations have been coming down pretty much in lockstep with them. And what that says to me is that we haven't been exaggerating the extent to which lower returns are going to increase the challenge of funding pension schemes. We're not exaggerating by looking at gilt yields. There is a challenge there. Having said that, this year, our 2017 assumptions, which will be published next week, but I can give you a little advance insight. They are coming down again as yields have collapsed again further over the last year. But actually the returns on the growth assets aren't coming down by quite as much. And what that really talks about is that they don't come always in lockstep day to day with the movement of gilt yields. It's a more slow-moving process, as an ongoing corrective process, as any process is that requires you to incorporate new and updated information. The trend is clear, but it's not moving about day to day with movements in gilt yields. Yet, we are framing it, or our pension funding challenge, by allowing them to move day to day in lockstep with gilt yields. And I do think that that creates a bit of a short-termism, and as I say, amplifies any stress or volatility in the gilt market to our pension reported pension funding levels. And it doesn't have to be so. But the trend is clear, whether it's fast-moving or slow-moving. And in the face of that, in the face of lower returns, we've seen what is by now a very prolonged hiatus in de-risking of investment strategies. So over the course of most of the noughties, we all know that pension funds de-risked fairly rapidly. But if you look at this chart, which shows, again, data from the PPF, the greens are sort of bond and cash assets, and the pinks and others are other growth assets. And if I look at the split between those two groupings, it's been pretty static for the last 4 or 5 years. And that's a direct response to this low return environment. Funds simply can't afford to de-risk to even lower returning investment strategies. They do need to generate a return. And there are some who would say, well, that is fiddling while gilts burn, and really you should get on with the job of hedging these things and collateralizing them more fully before the hole in our pension funds become irreparable. And that's really the collision of two different perspectives on what the assets are fundamentally for. So in the blue corner, we have what I'd call the collateralizers. It's a perspective that once you've made a promise, it should be cash funded and fully collateralized from the outset. And that perspective would have you making sure that you fully fund and always hedge with matching assets the promises that you have made. But in the red corner, we have the funders who take the perspective that we can't afford to cash collateralize. Actually, we need to use the assets to generate profitable levels of return that pay for the benefits over the long term. And as long-term investors, we can afford to do that and ride out any short-term volatility. And these two perspectives, I think, have been sort of slogging it out for the last number of years. The collateralizers is where we would like to be. It's where insurance companies are. They must take a premium to fully pay for the guarantee that they make up front. They then have to hedge that. And that's where pension funds would like to be. And it's ultimately where we need to head to. But it's not where we started out, because we made a lot of those guarantees retrospectively, and they weren't funded in advance. So we've got a lot of catching up to do. And that's why the funder perspective does have some merit. They say we can't afford to immediately cash collateralize these. We need to work these assets to help them to actually pay for these benefits. But you would have to acknowledge that there need to be checks and balances on whether that is going according to plan or if it's likely to deliver the desired outcome. Otherwise, you become hostage to wishful thinking about what kind of returns you might actually generate on the assets. And that's very much where US public plans are, for example. But as those two perspectives sort of try to gain ascendancy, we end up with this sort of compromise, which is to value the liabilities with respect to gilts, and that satisfies the collateralizer perspective, but to add a spread, often a fixed spread, to recognize the additional return you expect to earn above that, which satisfies the funder's perspective. But it's not really a satisfactory compromise. It leaves you kind of skewered on a Morton's fork in that you can't stabilize the balance sheet because you can't afford to invest all in gilts, then you'll never earn the spread. But so long as you're not investing in gilts, you're going to experience volatility. And it doesn't have to be so, because there are a number of assets which can satisfy both needs, which can provide a degree of collateralization, but also additional yield over and above what you can achieve from gilts. And this is principally in the wider credit spectrum, or those assets that throw off a reasonably stable degree of cash flow with little degree of default risk. And that's no secret. I think we are seeing pension funds and insurers using those types of assets more and more. Insurers, starting from the blue corner, are sort of being pulled towards the center through the profit motive. Whereas pension funds, starting from the red corner, are being pulled towards the center by the need to sort of stabilize and create less volatile strategies. And you would expect those to converge somewhere in the middle at some point. But we are a very long way away from convergence. On the left-hand side is a picture of what a typical annuity book investment would look like. And it's making very broad use of the credit spectrum. It's exploring illiquid and global sources of credit yield. And it's shaping it very much to the shape of the cash flow profile. Whereas pension funds are still, relatively speaking, quite tentatively allocating to extended credit. And they're doing it by buying more sort of bulk beta, sort of market benchmarks, and alpha look to be added beyond that, rather than shaping it to their particular needs. So it feels like we're a long way off convergence. And it certainly seems to us that pension funds can take a little bit more of a leaf out of the insurer's book and better stabilize and shape their assets to look a bit more like their liabilities. And that means looking at also the liability side. And maybe if I walk through this example, it will illustrate it. Plan A takes a valuation basis based on gilts, needs to generate a return above that of around 1%. So it follows a strategy which is anchored on gilts and allocates to global equity to pursue that additional return. And the total expected return there, using our assumptions from last year, not this year, unfortunately that number will come down this year, is about 3.4%. And when you measure the funding level volatility, which is just one measure of risk, but one that we do tend to use a lot, you get about 5.2. Plan B, on the other hand, says, well, our strategy is going to make wider use of credit and to expand what we admit as collateral in terms of how we're going to match the assets. And given that we're doing that, we can value our liabilities in a consistent way by using a default adjusted yield on the portfolio that we hold. So we're going to proxy their liabilities with long-dated sterling corporates, and they have a very credit-led strategy, which overall has the same expected return, and critically has a much lower reported funding level volatility. And it just gives you a little bit of space and room to breathe. Effectively, what happens is that Plan A is being penalized because it is such a very narrow definition of what collateralizes the liabilities. And it gets penalized in funding volatility terms for holding any other asset. Whereas Plan B has said, well, there's a broader base of what I can use as collateral, and I don't need to be penalized for actually making use of that. I used to do a lot of scuba diving. I was trying to think of an analogy for this. And unfortunately, I suffered terribly from seasickness, and I used to have a real time getting out to the dive site and a real time getting my gear on, but always I wanted to get off that boat as quickly as possible, because as soon as I jumped in the water, the seasickness would subside. But I had a friend who similarly suffered from seasickness, but he just couldn't get past the moment when you have to put on all this heavy gear, and so he would just lie and moan and continue to suffer through the seasickness, and I could never understand that. So I think Plan A is like my seasick friend. They're sticking with it no matter how much the boat rolls and pitches around, whereas Plan B is like me, jump off into the wider sort of deep blue sea of credit. And it is a wider deep blue sea. I think one of the things we observe is how the credit opportunity set has expanded over the last number of years. Since the financial crisis, I think we've seen of the order of $60 trillion of new issuance. And that universe has become much more diverse. A number of years ago, the US would have made up about 60% of the global credit set. Now it's more like about 40%, and more comes from outside of the US than inside the US. And about a fifth of it is actually emerging market debt, which is often investment grade. So it's a much bigger opportunity set. It's also longer in duration. And also we see rising correlations. Correlations between G7 country bond markets have risen from about 0.2 in the 80s to 0.8 over the last 10 years. And all of that creates the conditions to enable you to use a wider set of collateral to match your sterling liabilities. And it's hard to say that that comes with any impairment in the quality of that collateral. It's difficult to say that US Treasuries are less secure than UK gilts, and you can hedge the currency risk backed. Mind you, we don't know what's going to happen November the 8th, but we all wait with bated breath. And the other is that it sort of might amuse you to know that given the way the currency hedging markets work at the moment, actually when you cross-hedge currency from yen to sterling, we get a better yield from Japanese government bonds than we do from gilts at the moment. So go figure. So that was really what I wanted to say today. It's about, we can't make the pain go away. I still have to suffer my seasickness out on the way to the dive site, but we can build better strategies to cope with it, which are both about making greater use and shaping more to our specific liabilities, that widening credit opportunity set, and adjusting our valuation metrics to allow us to do that. Thank you.
Thank you, Sorca, for this introduction. James, do you want to provide some comments, initial at least?
Thanks, Sorca. I think that was a great summary of the issues, and I like the reference to Emperor Nero. I was actually asked at our pensioners' liaison meeting 2 days ago whether actually the gilt market represented an emperor with no clothes. But compared to that, the idea of being burnt alive for underperformance seems much scarier. I wonder if I might just start by asking the audience, if you don't mind, a little bit of participation. There's no apps involved here. A simple question, which is if you could just raise your hand if you think long-dated gilts, 30-year gilts at a yield of 1.75 represents a good long-term investment. Anybody? So for those streaming through online, nobody here has raised their hand that I can see. And just a second question quickly, which is, for those of you involved with pension schemes, which I think is everybody, could you raise your hand if you feel you're under some pressure to add to your portfolio of gilts? Hands raised up. Interesting, quite a lot not. That may be partly because people are not managing pension schemes portfolios, but about half and half, something like that. So I thought I just got a few comments to add to what Sorca said, and I thought I'd just declare my hand first, which is that my background is as a fixed income fund manager originally before coming to the BBC to look after the pension scheme there. And so I think of long-term government bonds or long-term bonds of any sort as just the ideal match for long-term liabilities. So one of the first things I was involved in when joining the BBC pension scheme was to put in place an LDI portfolio, which is still there as things stand. But obviously quite a lot has changed over the years. When I joined the gilt market in about 1990, long-term bond yields were 10%. It was quite difficult quite a lot of bonds had double-digit coupons, quite difficult to find a bond with a single-digit coupon actually. It was also a slightly sort of puerile, informal market in those days. The individual bonds had nicknames. So I think the 13.5s of 92 were the Winnie the Poohs, and not surprisingly, the 13.25s of 94 were the Eeyores. So that's the way the market operated. Now, clearly, as Sorca's slides show, a tremendous amount has changed since then. The level of decline in yields has been amazing. But I would say also there's some other changes to the structure of the market that have taken place. And as the responses to the questions, I think, showed earlier on, there are a lot of participants who are buying gilts because they have to, not because they want to. If you think of the broader market, the government is a forced seller, the Bank of England has been buying, and so you have this very large market that is to some extent dominated by people who are not very sensitive to the price. And in those circumstances, I think the potential for crashes or bubbles is higher than in other situations. Now, you might wring your hands at that, but that perhaps also brings some opportunities for those who are sometimes willing to go against the grain. Just the other broad macro point I wanted to make was that the size of the gilt market, the market value of the gilt market is something in the region of £2 trillion. The size of DB liabilities is in the region of £2.5 trillion. But once you take off the gilts owned by the Bank of England, the gilts owned by other central banks, gilts under the mattress of insurance companies, collectively, we as pension schemes can't really hedge more than about a third of our liabilities using gilts and swaps. So what to do? I think there's a dilemma there. The more we try to buy gilts, the more we push the price up of the bonds, and the worse our funding situation looks. So something has to give there, I think, and time is one. I don't have a crystal ball as to where the market's going to go. I don't have a great solution for the industry. Just to make a couple of comments about what we're doing at the BBC pension scheme. We're a £15 billion defined benefit pension scheme, and we have, as I said, a partial hedge using the gilt market. So we have a core portfolio of gilts that I think provides an important ballast, if you like, to the way we hedge our liabilities. But in addition to that, we've gone out of our way over the course of the past few years to add to other asset classes that we think will provide long-term cash flows that will help pay benefits, even if the short-term balance sheet hedge is not quite so good. So long lease property, infrastructure, including renewables, private credit, and all done, if we can, on an unlevered, relatively low-fee basis. So that's my summary of what we're doing. I think now is a good time to stop, and we can see if there are questions from the floor.
Thank you. Thank you, James. If you want to, so if you have any question, please raise your hand, or someone will give you a mic. Alternatively, you can email me your question, and I will see it. And I've got already a few. Sorca, first, I wanted to go back to your first slide on the history of the Bank of England interest rate, and it shows that it can move quite suddenly and significantly. Do you think we're likely to see the same thing when we start from rates which are near zero here, but also in many other countries and with large debt positions, negative or already at zero? Part of this question, when you're providing your answer, could you also give your best estimate of when you think the 10-year gilt will be above 2%? It's already at 1.1%. So.
Well, as I mentioned, we go through a pretty sort of detailed exercise to look at all these kind of questions. And really where it starts with is growth and productivity. So you would see potentially, a rapid rise in interest rates if there were a sudden takeoff in growth and an overheating of the economy, probably led by the US. And we see that as pretty unlikely. And I think the actions of central banks over the last year have finally convinced the market that it really is lower for longer. So we see a world where there will at some point be a gradual, very gradual normalization back to terminal levels which are much lower than we've had historically. So I can fall back on what my broader colleagues say rather than have to give an individual opinion. But we certainly think that it'll take, in the UK, north of 5 years to reach 2% or more on 10-year yields. Yeah, but no matter how long it takes, I mean, even if you have a scenario where yields suddenly take off, and that's going to be poor returns from bonds because you'll have sort of sudden capital losses, or even if it takes longer than that, then the very low yields means that it will be low return from bonds. So I think no matter which scenario you look at from here, it's low returns if you hold a bond asset.
James, do you have any thoughts on this in particular?
I suppose I would just say that this low yield environment presents lots of challenges, but when you look at it slightly longer term, actually it seems to me that it's not a bad scenario for the solvency of quite a lot of defined benefit pension schemes. If you can diversify to some other assets that bring a little extra yield in, if inflation's not too high, the benefits are not going up. So the potential to move gradually back to a better funded situation is actually not so bad, it seems to me, in a lower for longer type scenario when you've got a diversified portfolio of assets. So I think when we all sort of wish for higher yields, and I think we sometimes have to be careful what we wish for, because if that comes with higher inflation, then actually we could be out of the frying pan into a much worse fire, to go back to the Nero analogy.
It'd be nice to get some stability. Yeah.
Robert? Question. You don't have to, but it's coming to you.
Okay. So Robert Brown from Willis Towers Watson. Thank you, Luke. I have a question for James, actually. You talked about alternatives. I mean, both of you talked about alternatives to gilts as a way of dealing with the problem. What do you think about the level of pricing and returns in some of these assets, and how have they been affected over the last 5 years?
Yeah, so that's good question. And of course, what we've seen with QE is not just a move in gilt yields, it's a move in the relative pricing of a whole range of different asset classes. I mean, long-term corporate bonds in the UK are, whatever they are, 130 over gilts. So the yields on corporate bonds have come down just at the same pace, really, with some volatility, as gilts themselves. I mean, I think there are plenty of examples people around here could give of individual assets they might have seen that look very expensive. Some parts of the infrastructure market have become very expensive. There were some comments in the previous session there. I mean, I suppose just collectively, we would observe that there are quite a range of assets that haven't really moved as far as the gilt market has. So we were talking in our investment committee not so long ago about how long you needed to hold a gilt for to give you the same yield as owning a portfolio of UK commercial property for 1 year. And the answer then was about 9 or 10 years. And so you have, I think, seen some movement in these asset classes, but if what we're really going to see is lower for longer, it seems to me that there are still some very interesting opportunities there.
Yeah, I think we agree with that. I think on an absolute basis, maybe everything looks expensive, but you have to invest somewhere, so you find where the relative opportunities are. But I think what we've kind of seen over the last year is that, if you like, the global capital stack has all moved down one notch. There's basically no duration premium for holding long-dated government bonds. Corporate bonds are more a proxy for government bonds as they used to be. Equities, by being more focused on payouts, are acting more like corporate bond proxies. And really the venue for growth is in growth assets, or in the private markets. And in that kind of world, I think you have to reevaluate where the opportunities are and what your relative assessment of them is.
Question over there. Yes, go ahead.
John Pantor, Greater Manchester Pension Fund. We're a big fund, and we're still, with our income from investments, having a positive cash flow. However, I think part of the answer to the previous question really was linked to the question I'm going to ask. We've always been taught as quasi-trustees and trustees that we should, within an asset class, diversify. Now, when we look, and we've heard about gilts, but if we look at German bunds, where our speaker this morning said he sees the yield in 5 years' time being 0.25%. Do we actually take the view that James is putting forward, well, rely on other asset classes really to make up the yield gap? What's the risk in that? We know, as has been pointed out, that some corporate bonds, some emerging market debt, etc. Do we need to really, though, still get a balanced asset class portfolio and balance the risk against lower returns?
Who's that for? Me?
I think it's for you, James.
I mean, I think everyone needs to come to their own conclusions with their own advisors on these things. I think we've taken the view that, all these assets have risk. I mean, gilts have risks, obviously, of their own. Possibly not from a solvency perspective or solvency of the sponsor, but risks of their own. And anything else that you might buy in these areas have risks. And I think you and your fund managers need to make a judgment as to whether you think you're compensated for those risks that you're taking and how you diversify those risks not to be too exposed to any one particular area. I mean, I think we feel that if, we are also just about cash flow positive and have a long-term time horizon, but, that'll roll over a while. So you think about how long you want to hold these assets, but at the same time, we have a lot of transparency as to when we're going to need those cash flows over time. So if we're really just being paid, if we think we're just being paid for something that's illiquid, and there's no other reason why it yields more once you've adjusted for other factors than the liquidity, that's something that I think is a sensible thing for pension schemes to be taking on. And you heard from the PIP earlier on about the initiative there. But of course, there are risks across these different asset classes.
I think the dynamics are a little different if you're still cash flow positive and in accumulation mode, if you like, you're still accumulating assets relative to when you're in negative cash flow and really moving towards runoff mode and becoming more and more like an annuity book. But I think the diversification argument stands in both cases. It's just a different way to access and shape them. While you're still in accumulation mode, broadly accessing the market still makes sense. When you're in runoff mode, starting to shape it more and more to your particular profile becomes more important.
I think there was a question over there. Look.
Thank you. Julian Brown from BlackRock. Gilts were the original assets that you held to move like your liabilities. Would the speakers care to just comment a little bit about the potential for the LDI portfolios that you talked about, James, to give the leverage effect to effectively move even more like your liabilities if you don't hold enough?
So yeah, lots of pension schemes, well, as you'll know from BlackRock, employ leverage in their LDI portfolios or some sort of unfunded exposure, and whether that's through the repo market or whether that's to some extent just by buying ultra-long gilts. Yeah, I think there's, that's a strategy that's commonly adopted. I'm not quite sure what to say, except I think, these things might make a lot of sense individually, and for many maturing pension schemes, they particularly make a lot of sense. I mean, I think one of my points earlier on is that, collectively, there's a limit to the extent to which that solution works across the whole DB pension universe. In fact, there comes a point where it becomes counterproductive if you're not careful. So each pension scheme should work out how much it really needs to hedge through gilts. But if investors don't look for other things, then we'll collectively be worse off and gilt prices will be higher and our liabilities will look worse if we continue to use that for the discount rate.
Yeah, and I'd say that the gilts move like the liabilities because we told the liabilities to move like gilts, right? So there's a little bit of circularity there. And I think one of the points we're trying to make there is that we don't have to tell the liabilities that. We can say, actually, what you need to do is secure a set of cash flows that looks like your liabilities at a reasonable price. And if you define it that way, there are many other assets that can fulfill that role. And we suggest that that's something that pension funds should explore.
I think we're running out of time, but there's still room for one or two questions. Apologies if we are keeping you a little bit longer, but I think it's worthwhile.
Gillian Evans from Macquarie, and a question for James. You talked about the alternatives for gilts, and just wonder, and you mentioned a few of those: long lease property, private credit, and infrastructure. And as you look at those alternatives, how do you compare the relative opportunities in deciding how much to put in, whether or not on a relative basis they're worthwhile additions to the portfolio or not?
So we try to look at, we're less focused on a sort of bucket that we need to fill or populate, firstly, than where we think we're able to source assets from. And in some parts of the market, infrastructure debt, for example, it's quite easy to source assets. In other parts of the market, greenfield PPI infrastructure, it's very hard to source assets because there aren't any. So I suppose the first thing to say is we don't have buckets like that. We think about overall sort of scheme diversification, but really we're looking for assets where we think we get a risk-adjusted pickup over what we can find in listed bonds and equities. And if the answer is that we think we get a risk-adjusted pickup, then we're willing to do a material amount in those areas without being overly constrained by having a particular target allocation, within reason, of course.
Last question. Okay, perfect. Well, thank you very much for your time. Thank you for your questions. Thank you for those of you joining online. And thank you, James and Sorca, for your thoughts. And if you can join me in thanking them in the usual way, it'll be perfect.